Hey, what's going on everyone? It's Griffin here, and as always, I hope you're having a great day. Now, in today's video, we're going to be speaking about a combination of two of our favorite topics here on the channel, being both exchange-traded funds along with dividend stocks to bring forward a handful of quality dividend-focused exchange-traded funds. And we're also going to be speaking about covered call ETFs, which quite a few viewers had requested. Honestly, who doesn't love dividend income? It's one of the main ways that investors can create a new source of income for themselves. And even if it takes several years to build up a portfolio large enough to throw off enough dividend income each month to pay for all of your expenses, well, it's still a great way that you can contribute to the exponential growth of the value of your portfolio if you choose to reinvest your dividends. And by the way, if you're new to the channel, well, we've already covered dozens of quality dividend stocks, including bank, utility, telecommunication stocks, along with real estate investment trusts. So definitely make sure to check out the dividend investing playlist once you're done with today's video. And as always, before I go any further, if you're new to investing, make sure to check out the link down below where you can open up a Wealthsimple trade account, fund it with $100, and you will get $25 for free. So with that said, let's jump right into the first dividend-focused exchange-traded fund. All right, so first of all, I do want to mention that in the Canadian market, most quality dividend stocks are going to typically be found in one of the following industries, either the banking, telecommunication, utility, or energy industries. Those are really the main sectors, at least here in Canada, that will tend to hold companies that have a longer dividend distribution history, along with having higher dividend yields in general. So for this reason, a Canadian dividend-focused ETF is typically going to have a mix of companies that are within one of those industries, or in a variety of those industries, that is, and each different ETF is going to have a different weight associated to each position. But it is for this reason that most Canadian dividend ETFs all end up holding a mix of similar companies in their holdings. Definitely be aware of that. With that said, I chose one of these ETFs out of the bunch to mention in today's video because I felt it was a good balance between holdings allocations, fees, average returns over time, and then also dividend income. The dividend ETF in question is the Vanguard FTSE Canadian High Dividend Yield Index ETF, ticker symbol VDY. I'm pretty sure we've spoken about this dividend ETF most likely over a year ago now on the channel, and when I was doing research once again for this video, I felt it struck the best balance between all the elements that I just mentioned. First of all, the management expense ratio at 0.22%, while this is honestly quite a bit higher than some other passive funds like say VFV, well, in the realm of Canadian dividend ETFs, that's actually on the lower end of the scale, with many of the other options carrying MERs of 0.55, 0.60, and even 0.66. Now, let's take a look at the composition of VDY so we can get a better idea of what we're speaking about. So the fund only holds 48 stocks, which is definitely quite low for the average ETF, but this is what I was speaking about earlier regarding the fact that the Canadian market really doesn't have all that many dividend stocks. In fact, when taking a look at the charts of this fund's weighted exposure, well, it's evident that its composition is made up of stocks mainly from the financial industry, the energy industry, telecom, and then utilities. Now, when we explore the fund's individual holdings, the higher exposure to the financial industry becomes clearly visible, with around 14% of the total market value allocated to RBC and then 12.6% allocated to TD Bank. If you watched any of my Canadian bank stock videos, then you would know that both TD and RBC are Canada's top banks, at least in terms of size, market cap, and overall transaction volume by quite a long shot, and their dividend distributions are also quite reliable and attractive. In essence though, VDY's top 10 holdings account for just over 70% of the fund's entire market value. That's quite a bit, and for this reason, the fund's performance will be highly correlated with the performance of these top 10 holdings, which, since they are mostly in the financial industry, we can see that the past couple of years for VDY's performance has resembled the performance of, say, TD Bank. Speaking of performance though, the main reason why anyone would invest in an ETF like this one in the first place choice would be for the dividend. So currently, the fund has a trailing 12-month dividend yield of 4.16%. This fund does also distribute dividends on a monthly schedule, and as we can see from this chart, distributions have been steadily increasing since the fund's inception date at an average earnings growth rate of 5.6%. So all in all, VDY could definitely be a good option for a dividend-focused ETF for that investor who's looking for a more passive approach to their dividend investing without having to individually hand select each dividend stock, but still wants to gain a larger than market average dividend yield. The returns over time are also steadier than with, say, a higher growth-oriented ETF, but as a trade-off, returns are much slower due to the nature of the positions and are also correlated with the distributions quite a bit more. So don't expect massive capital growth. This is very much a dividend play. In fact, the cumulative 5-year returns for this fund are right around 61%. With that said, a couple things to keep in mind for a dividend ETF like VDY, along with pretty much all the other Canadian options, is you are definitely paying a premium for that level of passivity and exposure to a larger basket of Canadian dividend stocks. The 0.22% MER with this ETF in question is quite a bit lower than some of the other options here in Canada, but considering the fact that around 70% of the portfolio's weight is allocated to the top 10 holdings, you could be better off just hand selecting some of the top positions in this fund, including, say, RBC, TD Bank, Fortis Incorporated, and, say, TELUS, and this would save you from those higher MER fees in general. And at the end of the day, even though you are gaining a higher exposure to a variety of positions, you might not even want to be exposed to some of the top 10 holdings, let alone some of the other holdings in an ETF like this one, even if the exposure is quite minimal. Alright, so I'm making today's video because I did have quite a few viewers asking for a video on this topic, but the Canadian options for dividend-focused ETFs are quite limited. And so if you do choose to, let's say, go with an ETF like VDY, pretty much all the other equity-focused dividend ETFs in Canada are going to have severe overlap in regards to the holdings. With that said, one type of alternative security that we have actually spoken about quite a bit on the channel in the past are real estate investment trusts, acronym REITs. Essentially, REITs can provide a fantastic source of dividend income for investors because they're obligated to redistribute a high portion of their earnings back to shareholders in the form of a distribution. Now, I've spoken about some of my favorite Canadian real estate investment trusts, including more recently the Granite Real Estate Investment Trust. Definitely check that one out if you haven't already, but when it comes to an REIT ETF, I would sooner just focus on a couple individual REITs because the management expense ratios for REIT ETFs are quite high in the above 0.5% range, which is definitely on the higher scale for an exchange traded fund. And the reality is that REITs are extremely different in nature depending on the type of real estate that they hold. So I would focus more on industrial REITs right now along with residential REITs. So considering what I just mentioned, what would then be another potential alternative option for a dividend focused ETF here in Canada? Well, over the past couple of weeks, I have had quite a few viewers ask me to speak about covered call ETFs, which do tend to have a slightly higher distribution yield based on their nature. But since this is a topic that's pretty much new to the channel, let's speak about what this even is. To understand this though, we first need to speak about what call options are, because with a covered call ETF, the fund is essentially trying to create more income for investors by utilizing call options. And if this is the first time that you hear about this concept, well, essentially a call option is a contract giving the buyer of the option the right to purchase stock from the seller of the option at a set price for a limited time. And then from here, the buyer pays a premium to the seller of the option for that right of purchasing the stock at a set price. Now, that's pretty much all I'm going to say about call options, and I'm not going to get into the intricacies of them along with what options trading really entails because today's video is focused mainly on dividend-focused exchange-traded funds. With that in mind though, some investors do choose to use covered calls to try and increase their portfolio's income, and there's even specific ETFs that focus on a covered call strategy along with the traditional dividend income in order to create higher returns for investors. One of Canada's largest covered call ETFs is BMO's High Dividend Covered Call ETF, ticker symbol ZWB, which has just over $1 billion in assets under management. The goal of this ETF is to provide exposure to a dividend-focused portfolio while also earning call option premiums to increase income. ZWB distributes dividends on a monthly schedule, and as of the last distribution, the annualized yield was 7.49%, which is definitely quite high and would appear attractive to investors, even considering the higher MER of 0.72%. Now, if we actually look at the holdings of this fund though, we'll notice right away that they're actually quite similar to those in the VDY ETF that we previously looked over. There are quite a few more holdings, but the top ones include TD, RBC, CIBC, Manulife, etc. So in this light, while the VDY ETF has a yield of around 4.5% without a call option strategy, we can see that the covered call strategy has allowed this fund to generate a yield roughly 3% higher. So considering what we just spoke about, you might be thinking that this seems like a great option to increase your dividend income and for this reason, the overall growth of your portfolio. But this type of covered call ETF does also come with some pitfalls. First of all, a covered call strategy tends to limit upside in a bull market because if the value of shares held does increase above the strike price, the seller may be forced to sell the shares held above what they're actually worth in the market, which does dig into the income made from those premiums. Another element to consider is the fact that since distributions from a covered call ETF take into account a combination of both actual dividends from the companies held and also income from the performance of the covered calls, well, distributions can be quite a bit more volatile, hard to predict, and show less consistent increases over time. For example, when looking at the distributions of this ETF over the past 5 years, we can see that there is very minimal distribution growth even though the actual yield has remained high. In addition to this, the actual share value growth has been quite limited, where the ETF hasn't even yet fully recovered from the March 2020 crash. This is true for this covered call ETF along with others like the ZWB ETF, where recovery since last year's crash hasn't been nearly as high as with a traditional equity ETF exclusively. So when taking all of this into account, despite the notably higher yield, we can see that cumulative performance, including the dividends and taking into account MER, has resulted in a return since inception of only 17.39%, which was around 4 years ago. So I'm not saying that covered call ETFs are necessarily to be avoided, but since so many viewers did ask me to make a video about them, I wanted to highlight both the pros and cons, and then also shed some light on the fact that there is more to look at than just the dividend yield. Many dividend investors, especially newer dividend investors, make the mistake of pretty much only looking at the dividend yield, which, don't get me wrong, is very important because this will give you some insight into the amount of dividend income that you'll be able to generate in a calendar year. But the reality is that total return is ultimately what's important, and that's a combination of both the dividend income, but then also capital gains over time. So if the price of two stocks remained constant at $5 a piece forever basically, and one of them had a dividend yield of 5 versus the other one a dividend yield of 10%, well, of course, the 10% dividend yield would be advantageous, considering all things equal. But with moving asset prices, which is the reality of the open market, a total ensemble is what you need to look at. Alright, so that pretty much covers what I wanted to speak about regarding those two dividend-focused ETFs, but I wanted to leave you with a couple things to consider regarding whether or not a dividend ETF would be right for you. First of all, ask yourself whether or not you are willing to pay a higher management expense ratio for that added diversity and passivity over, say, hand selecting a handful of dividend stocks yourself. The second thing you should ask yourself is, do you really want exposure to all of those stocks in that ETF anyways? Chances are, in regards to a dividend ETF, it might make more sense to just hand select between, say, 3 to 5 really strong quality dividend stocks, because this will allow you to save on fees while also managing your dividend income more accurately. Next up, are you just looking for the highest yield possible, or are you actually looking and digging deeper into the overall returns of the dividend stocks and the dividend ETFs? And then finally, how would a dividend-focused ETF fit within your larger portfolio and strategy in the first place? It's always important to ask yourself some questions regarding a new position and also do some extensive research into that position in question before adding it to your portfolio. So with all that said, thanks a lot for watching today's video. I really hope it gave you some value. If it did, make sure to drop a like. It really helps the channel out. And also consider subscribing and hitting that bell button to be notified of new and upcoming stock market related content, but also real estate content in the near future. Now, if you're new to investing, I would also highly recommend that you check out the links down below to either open up a Wealthsimple trade account and then also to check out my full 60 video lecture stock market investing course, where you'll learn all the tools necessary to get on the right foot with your investing, navigating the market properly, and then also constructing your very own portfolio suitable for your needs as an investor. So with that said, thanks a lot for watching, and I will see you in the next one.